hold a single page from a Barclays bank ledger dated September 14, 2008. The paper is thin, almost translucent under fluorescent light. The entries are typed in courier font, each line representing a transaction that never touched American soil. Account 7739 USD. Depositor: Deutsche Bank AG, Frankfurt. Amount: $47,000, $47,000, $47 billion. Not in New York, not in Los Angeles, not anywhere the Federal Reserve could see it, regulate it, or rescue it. This single ledger page represents a fragment of the $13 trillion Eurodollar system, the offshore dollar market that exists everywhere and is controlled by no one. But this page was printed 18 hours before Lehman Brothers collapsed, and the men staring at it in London knew a secret that would destroy the global economy. The dollars were vanishing, not because the Federal Reserve stopped printing them, not because of subprime mortgages or housing bubbles or Wall Street greed, but because the shadow system that created more dollars than America ever minted was suffocating itself. The numbers were apocalyptic. On September 12, 2008, the Eurodollar interbank market processed $3 trillion in overnight lending. By September 15th, that number collapsed to $400 billion. By September 17th, it had fallen to $56 billion. That is not enough liquidity to fund global trade for 6 hours. 200 corporations had already frozen their credit lines, and the contagion was metastasizing across every continent. The world's financial system was 72 hours from a liquidation event that would have made the Great Depression look like a temporary inconvenience. This ledger page survived. The global economy nearly didn't. And the reason it barely survived tells you everything you need to know about the invisible architecture collapsing beneath the dollar right now. In 2026, the system that controls your mortgage, your pension, and every dollar-denominated asset you will ever touch. You need to understand what you're about to lose, not your stocks, not your crypto portfolio, not even your job, though all of those are at risk. What's at stake is something more fundamental: the invisible system that makes dollars work outside America's borders. The system that finances 80% of global trade. The system that allows your company to borrow at 3% instead of 15%. The system that keeps emerging markets from collapsing into hyperinflation every 18 months. This system, the Eurodollar market, is dying right now in 2026, and almost nobody understands what that means. Here's the brutal truth. Every mortgage, every corporate bond, every pension fund, every emerging market loan on Earth depends on a shadow banking system that operates beyond the Federal Reserve's control. When Lehman Brothers collapsed in 2008, the media blamed subprime loans. They were wrong. The crisis wasn't about bad mortgages. It was about the sudden evaporation of $3 trillion in offshore lending that happened before Lehman even declared bankruptcy. That was the Eurodollar system contracting, and it nearly ended modern civilization. The terrifying part? The exact same contraction is happening again right now, but bigger. Between 2023 and 2026, the offshore dollar market has shrunk by $4 trillion. $4 trillion. That's twice the speed of 2008's collapse, yet financial media is barely covering it. Why? Because understanding the Eurodollar market requires understanding a history most economists refuse to acknowledge: that the dollar's dominance was never about the Federal Reserve. It was about a shadow system born during the Cold War that accidentally became more powerful than the institution that prints the currency. You can't fix what you don't understand. And what's collapsing right now isn't just a financial system. It's the architecture of global power that's existed since 1957. This is the story of how the Eurodollar market was born, how it quietly became the most important financial system on Earth, and why its death in 2026 might be the most significant economic event of your lifetime. Because when the system dies, it won't just crash markets. It will rewrite the rules of international commerce, destroy nations that borrowed in dollars they can't access, and expose the terrifying truth that the world's reserve currency was never actually controlled by America at all. Moscow, February 1957. The Soviet Union faced a problem that would accidentally create the most powerful financial system in history. They had dollars, lots of them, earned from selling grain and gold to Western buyers who insisted on payment in US currency. But Stalin's successors understood something terrifying. Every dollar held in American banks could be frozen instantly if Cold War tensions escalated. One executive order from Washington and Soviet dollar reserves would vanish. The solution came from an unlikely source in Narodny Bank, the Soviet-owned commercial bank operating in London. Why not hold dollars in London instead of New York? British banks would accept dollar deposits. The funds would remain outside American jurisdiction, beyond the reach of U.S. Treasury sanctions. The Soviets could access their dollars without asking Washington's permission. The first Eurodollar was born not from capitalist innovation, but from communist paranoia. In February 1957, Narodny Bank deposited several $million with London merchant banks. The banks issued deposit certificates denominated in U.S. dollars but existing entirely outside the Federal Reserve System. These weren't pounds, they weren't rubles. They were dollars that lived in London, unregulated and untraceable by American authorities. The British banks immediately saw the opportunity. They could accept dollar deposits and lend those same dollars to other customers at higher interest rates. The spread between deposit rates and lending rates was pure profit. And here's the revolutionary part. British banks operating outside U.S. jurisdiction weren't subject to Federal Reserve regulations. No reserve requirements, no mandatory deposit insurance, no lending restrictions. A British bank could accept $1 million in deposits and immediately lend out the full million. Something American banks legally couldn't do. They were required to keep 10% in reserve. This created infinite leverage. The offshore dollar system could expand credit without the constraints that bound domestic American banking. Within months, other European banks noticed what was happening. Swiss banks started accepting dollar deposits. French banks joined. German banks participated. By 1960, the offshore dollar market had grown to roughly $3 billion. A tiny fraction of the U.S. money supply, but growing exponentially. The Federal Reserve watched nervously but did nothing. The man who understood the implications first wasn't an economist. Siegmund Warburg was a German Jewish refugee who'd fled the Nazis in 1934 and rebuilt his family's merchant banking empire in London. By 1957, he was running S.G. Warburg & Company, a boutique investment bank specializing in financing European reconstruction. Warburg saw the Eurodollar market and recognized it immediately as a regulatory arbitrage opportunity. American corporations needed dollars to finance European operations, but U.S. regulations made borrowing expensive. Interest rate ceilings limited what American banks could pay depositors, so they couldn't compete for funds. Capital controls restricted how much money corporations could move overseas, but if a corporation borrowed Eurodollars from a London bank, those regulations didn't apply. The dollars never touched American soil, so American law didn't govern them. Warburg structured the first major Eurodollar bond in 1963 for the Italian government. $15 million, issued in London, denominated in U.S. currency, sold to European investors. The innovation was elegant. Italy got dollars without going through American banks. Investors got dollar-denominated returns without U.S. withholding taxes. Warburg collected fees from both sides. The deal's success triggered an avalanche. Corporations and governments realized they could access dollar financing cheaper and faster through the Eurodollar market than through New York. No regulatory delays, no Federal Reserve approval, no congressional oversight, just pure frictionless capital allocation operating in the shadows of traditional banking systems. By 1965, the Eurodollar market had exploded to $13 billion. By 1970, it reached $100 billion. The growth was exponential, and the Federal Reserve was powerless to stop it. These dollars existed outside their jurisdiction, created by private banks making private lending decisions, beyond the reach of American monetary policy. Milton Friedman, the free market economist, who would later advise Reagan, saw the danger early. In a 1969 essay, he warned that the Eurodollar system was creating a parallel monetary system that could destabilize the global economy. His argument was simple but prophetic. If banks could create dollars without Federal Reserve oversight, they would inevitably overlend. When the inevitable contraction came, there would be no lender of last resort to prevent collapse. The Federal Reserve couldn't bail out London banks, and the Bank of England wouldn't bail out dollar obligations. The system was building leverage on leverage, with no safety net underneath. Nobody listened. The profits were too enormous, the system too useful. American corporations borrowed Eurodollars to build factories in Europe. European banks lent Eurodollars to finance infrastructure. Latin American governments took Eurodollar loans to fund development projects. The offshore dollar became the currency of global expansion, and everyone involved believed the music would never stop. The Federal Reserve made token efforts at regulation. In 1965, they imposed the interest equalization tax, trying to discourage Americans from investing offshore. It failed completely. Capital just moved faster to London. In 1968, they implemented voluntary capital controls, asking banks to limit foreign lending. Banks ignored them. By 1971, President Nixon abandoned capital controls entirely. The Eurodollar market had grown too large to regulate. Attempting to control it would just push the business to banks outside American influence. Here's how the system actually worked and why it was so dangerous. Start with a simple example. An American corporation, let's call it Global Tech, needs $50 million to build a factory in Germany. They could borrow from Chase Manhattan in New York, but U.S. banking regulations limit how much Chase can lend based on their reserve requirements and capital ratios. The approval process takes weeks. Interest rates are high because Chase must comply with Federal Reserve requirements. Or Global Tech could call Barclays in London. Barclays has dollar deposits from Saudi oil exporters who want to hold dollars outside U.S. jurisdiction. Barclays can lend those dollars immediately. No Federal Reserve approval needed, at interest rates 2 percentage points lower than New York rates because they don't have reserve requirement costs. The loan closes in 72 hours. Global Tech chooses Barclays. That $50 million loan just created new purchasing power in the global economy without the Federal Reserve printing a single new dollar bill. This is monetary expansion happening outside central bank control. Now multiply this by thousands of transactions. Every day, corporations, governments, and banks borrow Eurodollars for projects worldwide. Each loan creates new dollar-denominated credit. The system grows exponentially because there's no regulator limiting the expansion. American banks, watching this business move offshore, opened London branches to participate. By 1975, every major U.S. bank had a London office engaging in Eurodollar operations. They couldn't legally do in New York. They were arbitraging their own government's regulations, and the Federal Reserve couldn't stop them. The profits were staggering. A bank could accept dollar deposits at 3% interest, lend at 7%, and keep the 4% spread. With no reserve requirements, they could lend every dollar they received. $1 billion in deposits became $1 billion in loans, generating $40 million in annual profit. Banks competed viciously for Eurodollar deposits, offering slightly higher rates to attract funds. This created an interest rate spiral. To attract deposits, banks offered 4%. To maintain margins, they had to lend at 8%. To find borrowers willing to pay 8%, they lent to riskier projects in emerging markets. The credit quality deteriorated as the system grew. By 1980, the Eurodollar market exceeded $1 trillion. It had become larger than many national economies. Corporations in Brazil, Mexico, Indonesia, and Turkey had borrowed hundreds of billions in Eurodollars to finance development. They believed dollar liquidity was infinite, that they could always roll over maturing loans with new Eurodollar borrowing. They were building entire economies on a foundation of offshore credit that existed only because London banks kept lending. What nobody asked was the crucial question: what happens if the banks stop? What happens when a shock hits the system and offshore banks, suddenly afraid, refuse to roll over maturing loans? What happens when $3 trillion in Eurodollar credit that corporations and governments depend on simply evaporates because there's no Federal Reserve requirement forcing banks to keep lending? That question would be answered in 2008, and the answer would be catastrophic. Between 1980 and 2007, the Eurodollar system entered its golden age. The market exploded from $1 trillion to $13 trillion, growing faster than any monetary system in human history. This wasn't money the Federal Reserve created. This was credit generated by private banks making private decisions in London, Frankfurt, Singapore, and Hong Kong, completely beyond the reach of any central bank. The system worked so smoothly that people forgot it was even there. Corporations borrowed at rates that seemed impossibly cheap. Emerging markets financed infrastructure projects that transformed their economies. American pension funds earned stable returns on Eurodollar bonds. The complexity became invisible, replaced by the narcotic comfort of easy money. Everyone believed the liquidity would last forever. They were catastrophically wrong. The 1980s saw the first warning signs, but they were ignored. Latin America's debt crisis in 1982 began when Mexico announced it couldn't repay $80 billion in Eurodollar loans. Brazil, Argentina, and Chile followed. These countries had borrowed heavily in offshore dollars during the 1970s. When oil prices were high and commodity exports were booming, they believed they could always refinance maturing debt with new Eurodollar loans. But when Paul Volcker raised U.S. interest rates to break inflation, rates on Eurodollar loans spiked from 8 to 18%. Suddenly, debt service consumed 40% of export revenues. Countries couldn't pay. The crisis should have destroyed the Eurodollar market. Instead, it grew stronger. The Federal Reserve and IMF orchestrated bailouts that kept banks solvent and kept dollars flowing. The lesson everyone learned was wrong. They concluded the system was resilient, that authorities would always intervene to prevent collapse. What they should have learned was that the system only survived because central banks stepped in to provide dollars that the offshore market couldn't generate itself. The warning was ignored. Meet a fictional character based on countless real executives. His name is Carlos Mendes, Chief Financial Officer of Siderúrgica Brazil, a steel manufacturer in Sao Paulo. In 1995, Carlos faced a decision that would define his career and eventually destroy his company. Brazil had stabilized its currency with the real plan, bringing inflation under control for the first time in decades. Foreign investors were flooding in. The stock market was soaring. Carlos needed $500 million to modernize his steel plant, install new furnaces, automate production lines, triple capacity. Brazilian banks offered loans at 12% interest in reais. But Carlos's banker at Deutsche Bank offered something better, a Eurodollar loan at 3.5%. The math was simple. Borrowing in dollars saved $42 million annually in interest payments. Over 10 years, that was $420 million in savings, nearly as much as the loan itself. Carlos signed the paperwork. His board praised his financial acumen. Industry publications wrote profiles celebrating his sophisticated capital structure. What Carlos didn't understand, what almost nobody explained, was the assumption embedded in every Eurodollar loan: perpetual dollar availability. The loan required refinancing every 3 years. When the initial term ended, Siderúrgica Brazil would need to borrow new Eurodollars to repay the old loan. This was standard practice. Thousands of corporations rolled over Eurodollar debt constantly. The system worked perfectly as long as offshore banks kept lending. Carlos's steel plant was spectacular. The new furnaces were German engineering perfection. Production tripled. Revenues soared. The company expanded into exports, selling steel to Argentina, Chile, and Venezuela. Carlos borrowed another $300 million in Eurodollars in 1998 to build a second plant. The debt load reached $800 million, but revenue growth easily covered debt service. Rating agencies upgraded Siderúrgica Brazil's credit. Wall Street analysts recommended the stock. Everything was working exactly as Carlos had planned. Then came 1999. Brazil's currency crisis forced a devaluation. The real collapsed from 1-to-1 with the dollar to 2-to-1, then 3-to-1. Siderúrgica Brazil's revenues were in reais, but its debt was in dollars. Overnight, the $800 million debt effectively doubled in local currency terms. Debt service that had consumed 15% of revenues now consumed 50%. Carlos couldn't pay. He approached Deutsche Bank about restructuring. The answer was polite but final. Eurodollar loans don't restructure easily. The debt was held by dozens of investors across multiple jurisdictions. Renegotiation would require unanimous approval. Besides, other Brazilian companies were also struggling. Banks were reducing their Eurodollar exposure to Latin America. Credit lines were freezing. When Siderúrgica Brazil's loan matured in 2001, Carlos couldn't refinance. No bank would extend new credit. The offshore dollar market that had seemed infinite had simply closed. The company defaulted. Assets were liquidated. The spectacular steel plants Carlos had built were sold to a Chinese firm for 20 cents on the dollar. 10,000 workers lost their jobs. Carlos's reputation was destroyed. But he was just one victim among thousands. The pattern repeated across emerging markets throughout the 1990s and early 2000s. The terrible irony was that the Eurodollar system's greatest strength became its fatal weakness. The system's flexibility, the lack of regulation, the infinite leverage worked brilliantly during expansion, but it contained no mechanism for contraction. When confidence collapsed, the system didn't slow down, it stopped completely. By 2007, the Eurodollar market had reached $13 trillion. American banks had borrowed massively from offshore markets to fund mortgage lending. European banks had lent trillions in Eurodollars to Eastern European countries whose citizens took out mortgages in Swiss francs and dollars because interest rates were lower than in local currencies. Asian corporations had Eurodollar debt funding factories across China and Vietnam. The entire global expansion of the 2000s was built on offshore dollar credit. Nobody questioned where the dollars came from. Nobody asked who guaranteed the system. The assumption was universal and completely wrong. That dollars were infinite. That offshore banks would always lend. That the Federal Reserve somehow backed this $13 trillion shadow market. The Fed backed nothing. They had no jurisdiction, no authority, no responsibility. The dollars existed as accounting entries on bank balance sheets in London, Frankfurt, and Singapore. They were created by banks lending to each other, by banks lending to corporations, by the endless circulation of credit through an unregulated system that had grown far beyond anyone's control. The rot became visible in August 2007, though almost nobody recognized it. BNP Paribas, one of France's largest banks, froze redemptions on 3 investment funds. The reason given was technical. They couldn't value the mortgage-backed securities the funds held because markets had become illiquid. But the real reason was different. BNP couldn't get dollars. The Eurodollar interbank market, where banks lent to each other overnight, was freezing. Banks that had lent to each other freely for decades suddenly stopped. Trust evaporated. If you lent overnight to another bank, would they repay tomorrow? Nobody knew. So banks stopped lending. This was the first tremor. The Eurodollar market wasn't collapsing because of subprime mortgages. It was collapsing because banks no longer trusted each other to have access to dollars. The mortgages were just the excuse. The real problem was systemic. A $13 trillion credit system built entirely on trust was discovering that trust could vanish instantly. Lehman Brothers held $200 billion in Eurodollar funding when the crisis hit. They borrowed short-term from offshore banks and lent long-term to finance everything from mortgages to commercial real estate. Every day they needed to roll over maturing loans, borrowing new dollars to repay yesterday's loans. It's called maturity transformation, and it only works if lenders keep lending. In September 2008, they stopped. Lehman called Deutsche Bank, no dollars available. Called Barclays, no dollars. Called Credit Suisse, no dollars. The offshore market that had functioned flawlessly for 50 years simply closed. Lehman couldn't roll over its debt. Without daily access to Eurodollar funding, Lehman Brothers couldn't operate for even 48 hours. The firm that survived the Great Depression, that had weathered every financial crisis for 150 years, collapsed in 4 days. Not because they ran out of assets, because they ran out of access to offshore dollars. And Lehman was just the beginning. The Eurodollar market's seizure would nearly destroy the global economy within weeks. The invisible system everyone had forgotten existed was about to become visible through its catastrophic absence. What if Paul Volcker had regulated the Eurodollar market in 1980? This isn't idle speculation. It was a real possibility debated at the highest levels of American economic policy. Volcker, then chairman of the Federal Reserve, understood the danger perfectly. He'd watched the offshore dollar market grow from $3 billion to over $1 trillion during his career. He knew it was creating credit beyond the Fed's control, building leverage that could destabilize the entire global system. In 1979, he commissioned an internal study examining whether the Federal Reserve could regulate Eurodollar operations. The conclusion was technically yes, legally complicated, politically nearly impossible. The study proposed requiring American banks to hold reserves against their offshore dollar lending, effectively extending Federal Reserve jurisdiction to London branches. The proposal would have contained the system's growth. Banks would face the same reserve requirements offshore that limited their domestic lending. The infinite leverage would disappear. Credit creation would slow dramatically. But the proposal died in committee, killed by a coalition of banking interests and free market ideologists who argued regulation would simply push business to non-American banks. If Citibank's London branch faced reserve requirements, corporations would borrow from Barclays or Deutsche Bank instead. American banks would lose market share. The Eurodollar market would keep growing, just without American participation. The argument won. Volcker backed down. The market remained unregulated. Imagine the alternative timeline. Suppose Volcker had pushed the regulation through despite banking industry opposition. Suppose he'd convinced President Carter, then Reagan, that containing the Eurodollar market was worth the short-term cost of reduced American bank competitiveness. What would have happened? The offshore dollar market would have grown slower, maybe reaching $3 trillion by 2007 instead of $13 trillion. Corporations would have paid higher interest rates, reducing leverage throughout the system. Emerging markets would have borrowed less, built smaller infrastructure projects, grown more slowly but more sustainably. The 2008 crisis would likely still have happened. Housing bubbles don't require Eurodollars, but the systemic collapse would have been contained. Without $13 trillion in unregulated offshore credit, the banking system's seizure would have been severe but not apocalyptic. Lehman might have survived. The Federal Reserve's interventions would have been smaller. The Great Recession might have been just a regular recession. Global growth from 1980 to 2007 would have been slower, maybe 1 percentage point less annually. Compounded over 27 years, global GDP would be roughly 20% smaller. Millions fewer jobs would have been created. Infrastructure projects in China, Brazil, and India would have been delayed by years. The prosperity of the late 20th century would have been diminished. This is the trade-off nobody wanted to acknowledge. Regulation would have prevented catastrophe but also prevented growth. Volcker chose growth. So did every Federal Reserve chairman who followed him. Greenspan actively celebrated the Eurodollar market as an example of beneficial financial innovation. Bernanke studied it academically but never proposed regulation. The system was too useful, too embedded, too profitable to constrain. But there's a deeper counterfactual worth exploring. What if the Eurodollar market had never been created at all? What if the Soviet Union in 1957 had simply accepted the risk of holding dollars in New York? What if British banks had refused to accept dollar deposits? Or what if the Bank of England had immediately prohibited the practice? The global economy would look unrecognizably different. Without Eurodollars, international trade would have required much more currency conversion. Corporations couldn't borrow dollars offshore, so they borrow in local currencies at higher rates. This would have fragmented global capital markets. Capital would have been trapped within national borders by exchange rate risk and currency controls. The dollar's dominance would be reduced, maybe eliminated entirely. Without the Eurodollar system providing dollar liquidity globally, countries would have needed alternative reserve currencies, perhaps a basket of currencies, perhaps gold. Perhaps IMF special drawing rights would have become the medium of international exchange. The American financial system would be smaller, less central to global commerce, less able to leverage its currency status to run perpetual trade deficits. American living standards would be lower, constrained by the need to balance trade without relying on foreigners' willingness to accumulate dollar assets. But crises like 2008 wouldn't happen, at least not the same way. The systemic fragility created by $13 trillion in unregulated offshore credit simply wouldn't exist. The Eurodollar market created what economists call a fragility trap. A system that appears robust during expansion, but contains hidden vulnerabilities that emerge catastrophically during stress. The trap operated through three mechanisms that fed on each other. First was maturity mismatch. Banks borrowed short-term and lent long-term. They'd accept overnight deposits from other banks and use those funds to make 3-year corporate loans. This worked perfectly in stable conditions. The overnight funding rolled over automatically. Nobody withdrew their deposits. But if overnight lenders suddenly refused to roll over funding, banks would have long-term assets and no short-term funding. They'd be solvent but illiquid, holding valuable loans but unable to access cash to meet withdrawal demands. This is exactly what killed Lehman. Second was currency mismatch. Corporations and governments borrowed dollars but earned revenue in local currencies. Carlos Mendes' steel company is the perfect example. $800 million in dollar debt. Revenues entirely in Brazilian reais. As long as exchange rates remained stable and Eurodollar credit kept flowing, the arrangement worked. But when Brazil's currency collapsed and Eurodollar credit froze simultaneously, the company had no way to repay. This pattern repeated across every emerging market. Third was interconnection without coordination. The Eurodollar market connected every major bank in the world through a web of loans, derivatives, and counterparty relationships. Bank A lent to Bank B, which lent to Bank C, which had exposure to Bank A through derivatives. The complexity became impossible to map. Nobody knew their true exposure. When confidence collapsed, every bank simultaneously tried to reduce exposure to every other bank. The system seized like an engine without oil. Each mechanism alone was manageable. Combined, they created systemic fragility that made collapse inevitable. The only question was timing. What would trigger the crisis? As it turned out, subprime mortgages provided the spark. But they weren't the fuel. The fuel was $13 trillion in unregulated offshore credit, built on assumptions that proved catastrophically wrong. The assumptions were simple and universal. That dollars would always be available. That banks would always lend to each other. That the Federal Reserve somehow guaranteed the system even though legally it didn't. When these assumptions shattered in August 2007, 50 years of accumulated leverage unwound in weeks. The alternative history, where Volcker regulated the Eurodollar market in 1980, would have prevented this specific crisis, but it would have created different problems: slower growth, higher unemployment during the 1980s recession, less dramatic poverty reduction in emerging markets. Policymakers chose the growth. They accepted the fragility risk, probably without fully understanding how catastrophic the eventual crisis would be. This is the terrible calculus of financial regulation. Preventing crises requires constraining growth, but politicians and central bankers face enormous pressure to maximize growth in the present, even if it creates disaster in the future. Volcker couldn't sell a policy that would reduce growth by 1% annually to prevent a crisis that might happen in 20 years. So he didn't. The crisis happened anyway, 28 years later. Exactly as the unemplemented 1979 study predicted. The counterfactual question haunts economic policy to this day. Is it worth preventing growth to avoid catastrophe? The answer determines everything about how we regulate financial markets, and we still haven't agreed on it. What's certain is that the choice made in 1980 led directly to September 2008, when the Eurodollar market stopped functioning and nearly ended modern civilization. August 9, 2007. BNP Paribas issues a statement at 8:47 a.m. Paris time. 3 investment funds are freezing redemptions. The reason given is technical market conditions. The real reason changes everything. BNP Paribas cannot obtain dollars. Not because they lack assets. Not because they're insolvent. Because the Eurodollar interbank market has stopped functioning. Banks are refusing to lend to each other. The most liquid market in human history, where $3 trillion changed hands daily, has seized. Overnight, without warning. Nobody in the financial media understands what this means. The coverage focuses on subprime mortgages, on housing prices, on American consumer debt. They're looking at the spark while missing the powder keg. The Eurodollar market freezing is patient zero of the global financial crisis. Everything that follows, every bank failure, every government bailout, every pension fund collapse, traces back to this moment when offshore banks stopped trusting each other with dollars. Within hours, the European Central Bank injects 95 billion euros into the banking system. Emergency liquidity. The statement is calm, measured, designed not to cause panic, but central bankers understand what's happening. The Eurodollar market operates on confidence and trust. When banks stop trusting each other, the system doesn't slow down. It stops. Completely. By August 10th, overnight Eurodollar lending rates spike from 5.3% to 6.7%. That doesn't sound dramatic until you understand what it means. The overnight rate is what banks charge each other for 24-hour loans. It's the foundation of the entire credit system. Every other interest rate in the global economy is priced off this rate. When it jumps 1.4% in 24 hours, that's not market volatility. That's system failure. Banks are charging each other crisis rates for overnight loans because they believe there's a real chance the borrower won't exist tomorrow to repay. Think about that. These are major international banks, institutions that survived world wars and depressions, charging each other loan shark rates for 24-hour loans. The mathematics of trust have collapsed. September 12, 2008, Lehman Brothers holds $200 billion in Eurodollar funding. They need to roll over $18 billion today alone. Dick Fold, Lehman's CEO, spends the morning calling counterparties. Deutsche Bank, no liquidity available. Barclays, unable to extend credit. Credit Suisse, reviewing exposure limits. Royal Bank of Scotland, no dollars. Every call ends the same way: polite, professional, final. The Eurodollar market has closed to Lehman. Without daily rollovers, Lehman cannot operate. They call the Federal Reserve. Tim Geithner, president of the New York Fed, explains the terrible truth. The Fed cannot provide Eurodollar funding. Those are private contracts between private banks in foreign jurisdictions. The Federal Reserve has no authority to intervene. Lehman has 170 years of history, $639 billion in assets, 25,000 employees. In 72 hours, it will cease to exist. Not because the assets are worthless, because the Eurodollar funding has evaporated. September 15th, Lehman declares bankruptcy at 1:45 a.m., the largest bankruptcy in American history. The news hits trading screens in London at 6:45 a.m. By 7 a.m., the Eurodollar interbank market has completely frozen. Not just reduced, frozen. Zero transactions. Banks are refusing to lend to anyone for any term at any price. The system that allocated $3 trillion daily across borders has stopped. Globally, within hours, corporations start calling their banks. Can we roll over our commercial paper? No. Can we draw on our credit lines? No. Can we access the Eurodollar loans maturing next week? No. Companies with perfect credit ratings, with profitable operations, with zero connection to subprime mortgages, suddenly cannot access capital. Because capital doesn't exist, the Eurodollar market has vanished. General Electric, one of America's most stable corporations, cannot sell commercial paper. Toyota cannot fund its dealer network. Caterpillar cannot finance equipment purchases. The real economy is seizing because the shadow banking system that financed it has disappeared. September 16th, money market funds start breaking the buck. The Reserve Primary Fund, holding $62 billion in assets, announces its net asset value has fallen below $1 per share. Investors panic. If money market funds aren't safe, nothing is safe. They demand redemptions. $200 billion in redemption requests hit money market funds in 48 hours. The funds cannot meet redemptions because they hold commercial paper and Eurodollar deposits that cannot be sold. There are no buyers. The market has stopped functioning. September 17th, $3 trillion in Eurodollar interbank lending on September 12th, $400 billion on September 15th, $56 billion on September 17th. The system has contracted by 98% in 5 days. 98%. That is not a market correction. That is liquidation. That is systemic collapse. Global trade starts grinding to a halt. Letters of credit, the financial instruments that guarantee payment between buyers and sellers across borders, become impossible to obtain. Without letters of credit, exporters won't ship goods. Without goods flowing, supply chains break. Factories close. Workers are laid off. The real economy is dying because the invisible financial system that sustained it has stopped. Asian stock markets are in freefall. European banks are calling regulators in panic. American Treasury Secretary Hank Paulson realizes he's watching the global financial system collapse in real time. September 18th, Paulson and Bernanke meet with congressional leaders. Bernanke's message is simple and terrifying. If we do not act immediately, we will not have an economy on Monday. Not a recession, not a depression. No economy. The Eurodollar market seizure is cascading through every bank, every corporation, every country. Without intervention, the global credit system will suffer complete liquidation within 72 hours. Cash will be worthless because banks won't exist to process transactions. Supply chains will disintegrate because trade cannot be financed. Modern civilization, which runs entirely on credit, will cease functioning. The domino sequence accelerates. AIG, the insurance giant, has sold $500 billion in credit default swaps backed by nothing except the assumption that Eurodollar markets would keep functioning. With Eurodollar markets frozen, AIG cannot meet collateral calls. They need $85 billion immediately, or they collapse. If AIG fails, it triggers credit default swap payouts that will destroy Goldman Sachs, Morgan Stanley, Bank of America, every major financial institution globally. Iceland's entire banking system collapses. 3 banks holding assets equal to 10 times Iceland's GDP are wiped out in 4 days. The krona loses 50% of its value overnight. The country faces sovereign bankruptcy. Ireland's banks fail. The government guarantees all deposits, nationalizing the banking system at a cost equal to 3 times national GDP. The sovereign debt crisis begins. The contagion spreads faster than anyone predicted. South Korea faces bank runs. Brazil's currency collapses. Russia suspends its stock market indefinitely. The global financial system is experiencing cascading failure. Each bank's collapse triggers counterparty failures. Each counterparty failure triggers derivative payouts that destroy other institutions. The interconnection that made the system efficient during expansion makes it catastrophically fragile during contraction. Lehman's bankruptcy alone triggers $600 billion in credit default swap exposure. Nobody knows who owes what to whom. The complexity that hid risk during good times now paralyzes the system. Banks stop trusting their own balance sheets. If they can't calculate their exposure, they cannot lend, cannot borrow, cannot function. By September 19th, Treasury Secretary Paulson proposes the $700 billion TARP bailout. The number is almost arbitrary, large enough to signal seriousness, small enough to pass Congress. The real requirement is unknowable because nobody can calculate total exposure to Eurodollar collapse. But everyone understands that without intervention, civilization has 72 hours remaining. The invisible system is now visible through its absence, and what everyone sees is terrifying. The global economy ran on credit that existed nowhere, controlled by no one, backed by nothing. When that credit vanished, everything stopped. While civilization teetered on the brink, a handful of people understood exactly what was happening and positioned themselves to profit from the apocalypse. They weren't lucky, they were prepared. John Paulson had spent 2 years building the largest bet against subprime mortgages in history. But Paulson understood something most traders missed. The subprime crisis was just a symptom. The real disease was Eurodollar market fragility. In 2006, he'd studied the offshore dollar system and reached a chilling conclusion. Banks had built their entire business models on Eurodollar funding that could disappear instantly. When confidence broke, the cascade would be unstoppable. Paulson created credit default swaps on financial institutions, essentially insurance policies that paid out when banks failed. He bought protection on Lehman, Bear Stearns, Washington Mutual. Every major institution depended on Eurodollar funding. The positions cost him $100 million in premiums. When the crisis hit, they paid $15 billion. $15 billion in profit from understanding one thing. The Eurodollar market was a house of cards. Ray Dalio saw it differently but reached the same conclusion. Dalio ran Bridgewater Associates, the world's largest hedge fund. In 2007, he published an internal memo titled The Coming Liquidity Crisis. The analysis was precise. The global financial system depended on $3 trillion in daily Eurodollar interbank lending. That lending operated entirely on trust. When trust broke, the contraction would be immediate and catastrophic. No gradual decline. Total seizure. Dalio positioned his fund defensively, buying gold, selling financial stocks, purchasing long-dated treasury bonds. When the crisis destroyed markets, Bridgewater returned 14%, while the S&P 500 collapsed 37%. Dalio's clients gained $10 billion, while everyone else lost everything. The insight cost nothing. The profit was extraordinary. These weren't inside traders. They didn't have secret information. They simply understood the architecture of the system better than anyone else. They'd studied the Eurodollar market structure, recognized the fragility, and positioned accordingly. What separated them from the thousands of portfolio managers who were destroyed wasn't intelligence. It was willingness to believe the system could fail completely. Most analysts understood the housing bubble. Few understood that housing was irrelevant. The Eurodollar market structure guaranteed systemic collapse eventually. Housing just happened to be the trigger. It could have been anything. The shadow banking system was a bomb waiting for a spark. Michael Burry, the neurologist turned investor profiled in The Big Short, articulated this perfectly in a 2008 letter to investors. Everyone focused on subprime mortgages, but the mortgages were just collateral backing Eurodollar funding structures. When the collateral looked questionable, Eurodollar lenders panicked. The panic was rational. These institutions were borrowing billions overnight to fund 30-year assets. One bad day and you're insolvent. I didn't bet against housing. I bet against Eurodollar fragility. Burry turned 100 million into 700 million. The profit came from understanding system architecture, not housing economics. But while some prospered, others orchestrated the rescue. Bernanke faced a decision no Federal Reserve chairman had confronted since the Great Depression. The Eurodollar market was collapsing, but legally, the Fed had no jurisdiction over offshore dollar markets. These were private contracts between private banks in foreign territories. The Federal Reserve Act didn't grant authority to intervene in London interbank lending. Bernanke's staff prepared legal memos explaining the constraints. The Fed could lend to American banks through the discount window. They could conduct open market operations buying treasury securities. They could adjust interest rates, but they couldn't force British banks to lend Eurodollars to German banks. That was beyond their mandate. Bernanke ignored the legal constraints. On September 18, 2008, he authorized unlimited dollar swap lines with foreign central banks. The mechanism was elegant. The Fed would lend dollars to the European Central Bank, the Bank of England, the Bank of Japan, the Swiss National Bank. Those central banks would then lend dollars to their domestic banks. The dollars would flow into the Eurodollar market, replacing the funding that had evaporated. The swap lines were technically legal. The Fed was lending to other central banks, which was permitted, but the purpose was to inject dollars into private offshore markets, which the Fed had no legal authority to support. Bernanke was stretching his mandate to its breaking point. The alternative was global systemic collapse. The swap lines opened with 500 billion available. Within weeks, foreign central banks drew 580 billion. The dollars flooded into European and Asian banking systems, flowing immediately into Eurodollar markets. Banks that couldn't borrow from each other could borrow from their central banks. The Fed had become the lender of last resort for a $13 trillion shadow market it didn't regulate and legally didn't control. The precedent was staggering. The Fed was now explicitly backstopping the Eurodollar system. For 50 years, the offshore dollar market operated without any government guarantee. That ambiguity was gone. Everyone now knew when Eurodollar market seized, the Federal Reserve would intervene regardless of legal constraints. The moral hazard was obvious. Banks could continue building massive Eurodollar positions knowing that systemic collapse would trigger Fed intervention. The offshore market that was supposed to operate without government backing now had an implicit Federal Reserve guarantee. But Bernanke had no choice. Without the swap lines, the global banking system would have suffered complete liquidation by September 22nd. The legal niceties of Fed jurisdiction mattered less than preventing civilization's collapse. Critics attacked the decision immediately. Ron Paul, the Libertarian congressman, called it the greatest expansion of Federal Reserve power in history, conducted without congressional approval or public debate. He was correct. Bernanke had unilaterally committed to backstop $13 trillion in private offshore debt. But the critics offered no alternative except watching the global economy disintegrate. The swap lines worked. By early October, Eurodollar interbank lending began recovering. Not to normal levels, but enough to prevent total collapse. Banks started trusting each other again because they knew the Fed would provide dollars if necessary. The crisis stabilized. Civilization survived. But the cost was enormous. The Federal Reserve's balance sheet exploded from 900 billion to 4.5 trillion. The dollars injected into the global system created the foundation for a decade of quantitative easing and zero interest rates. The Fed had saved the Eurodollar market by expanding dollar supply massively. Those dollars remain in the system today, distorting every market, inflating every asset, creating bubbles in real estate, stocks, bonds, and cryptocurrencies. The 2008 rescue prevented immediate collapse but created the conditions for the next crisis. Return to Carlos Mendes in São Paulo. Siderúrgica Brazil declared bankruptcy in November 2008. The Eurodollar market's collapse meant the company couldn't refinance its $800 million in offshore debt. No bank would extend new credit. The existing loans were called. Carlos had no options. The company that employed 10,000 workers, that had been profitable for 70 years, that produced world-class steel, ceased to exist because it couldn't access dollars. The liquidation was brutal. The steel plants Carlos had built with German technology were sold at auction for $200 million, 25% of their replacement value. A Chinese state-owned firm bought them. The equipment was disassembled and shipped to Guangzhou. 10,000 workers lost their jobs immediately. Most were middle-aged men who'd spent entire careers at Siderúrgica Brazil. They had mortgages, families, skills specific to steel manufacturing that weren't transferable. Unemployment in São Paulo's steel industry reached 37%. Carlos himself was destroyed. Industry publications that had praised his financial sophistication now blamed him for over-leveraging. His reputation was ruined. He couldn't find work in finance or manufacturing. At 54 years old, he was unemployable. He sold his house, moved in with his brother's family, spent his savings. By 2010, he was working as a part-time accountant, earning 1/10 of his former salary. The professional life he'd built over 30 years was gone. His story repeated across emerging markets. Turkish construction companies that had borrowed Eurodollars to build infrastructure collapsed when credit froze. Indonesian manufacturers dependent on offshore dollar financing for imports went bankrupt. South African mining companies leveraged with Eurodollar debt liquidated assets. The human toll was staggering. The IMF estimates that the Eurodollar market's collapse destroyed 20 million jobs globally between 2008 and 2010. 20 million people whose employment depended on companies accessing offshore dollar credit lost their livelihoods when that credit vanished. These weren't Wall Street bankers. They were factory workers in Brazil, construction laborers in Turkey, retail employees in Indonesia. They had no connection to subprime mortgages or credit default swaps. They lost their jobs because the invisible financial architecture supporting their employers disintegrated. The geographic distribution was cruelly unequal. The United States lost 8 million jobs. Terrible. But America had the Federal Reserve to provide emergency liquidity. Emerging markets lost 12 million jobs because they had no central bank that could print dollars. When Eurodollar credit dried up, their companies simply died. The wealth destruction was similarly distributed. In America, home prices fell 30% peak to trough. Painful, but recoverable. In emerging markets, currencies collapsed 50 to 70% against the dollar. Families that borrowed in dollars saw their debt double or triple in local currency terms. They lost homes, businesses, life savings. The invisible system that had seemed to make everyone richer during the boom extracted catastrophic costs during the bust, and the costs fell hardest on those least responsible for creating the fragility. The bankers who built the Eurodollar system received bailouts. The workers whose jobs depended on that system received unemployment checks that expired after 6 months. The asymmetry was obscene. John Paulson made $15 billion betting against the system. Carlos Mendes lost everything trusting the system. Paulson bought a townhouse in Manhattan for $41 million. Carlos moved in with relatives. The system rewarded those who understood its fragility and destroyed those who believed its promises. This is the true human cost of the Eurodollar market's collapse. Not the bank failures, not the stock market crashes. The millions of ordinary people whose lives were shattered by the failure of a financial system they didn't understand, couldn't control, and never consented to depend on. They went to work, paid their bills, saved for retirement, and discovered too late that their economic security rested on $13 trillion in shadow credit that could evaporate overnight. When it did, they paid the price while the architects of the system walked away wealthy. Justice was never part of the equation. It's happening again, right now. The exact same contraction that destroyed the global economy in 2008 is unfolding in 2026, but faster and larger. The Eurodollar market has shrunk by $4 trillion since 2023. That's twice the speed of the 2008 collapse. Yet financial media barely covers it. Why? Because understanding the Eurodollar market requires acknowledging that the dollar's dominance was always built on a shadow system beyond anyone's control. Between January 2023 and December 2025, cross-border dollar lending fell from $9 trillion to $5 trillion. The mechanics are identical to 2008. Banks are reducing exposure to each other. Overnight lending rates are spiking. Corporations are finding it harder to roll over maturing Eurodollar debt. The early warning signs are flashing red. Emerging markets are suffering first as always. Turkey faces a currency crisis as Eurodollar credit dries up. Pakistani companies can't refinance dollar debt. Brazilian corporations are liquidating assets to raise dollars. The same pattern that destroyed Carlos Mendes' steel company in 2008 is destroying thousands of companies right now in 2026. But this time, the contagion is spreading faster. China's property developers borrowed $500 billion in Eurodollars during the boom years. That debt is maturing between 2024 and 2024. They can't refinance. The defaults are cascading through the Chinese financial system. European banks that lent those Eurodollars are recognizing losses. The interconnection is tightening. Every bank that suffers losses becomes more cautious about lending. Every reduction in lending forces more companies to default. The death spiral is accelerating. The Federal Reserve sees it happening but has limited options. They raised interest rates in 2022 and 2023 to combat inflation. Those rate hikes made Eurodollars scarce and expensive. Companies that borrowed cheaply at 2% in 2020 now face refinancing at 7%. Many can't afford it. The Fed could cut rates, but that would reignite inflation. They're trapped between inflation and deflation, growth and collapse. Meanwhile, the offshore dollar system is starving. The difference from 2008 is that central banks have less ammunition. In 2008, the Fed's balance sheet was $900 billion. They could expand to $4.5 trillion. Today, they're trying to shrink from $9 trillion back down. There's less capacity to rescue the system. The dollar swap lines still exist, but political opposition has grown. Republicans and Democrats both question why the Fed should bail out foreign banks again. Return to the Barclays ledger from September 14, 2008. Hold it next to a 2026 balance sheet from any major international bank. The structure is identical. Eurodollar deposits funding long-term assets. Overnight borrowing supporting 3-year loans. Leverage built on trust that could evaporate instantly. Nothing changed. The 2008 crisis was supposed to fix this. Dodd-Frank regulations. Basel III. Capital requirements. Stress tests. All designed to prevent another Eurodollar collapse. But the regulations only applied to American banks operating in America. The offshore dollar market remained beyond regulatory reach. The ghost in the machine persists. Today, the Eurodollar market is smaller than 2008, down from $13 trillion to roughly $9 trillion. But $9 trillion is still larger than the GDP of every country except America and China. It's still the dominant system financing global trade. It's still built on the same fragile foundation, trust between banks operating beyond any government's control. The system survives because everyone believes the Federal Reserve will intervene again if necessary. Bernanke's 2008 swap lines created an implicit guarantee. Banks lend Eurodollars knowing that systemic collapse will trigger Fed rescue. The moral hazard is baked into the architecture. But what if next time the Fed can't intervene? What if political opposition prevents another bailout? What if inflation is too high to allow massive dollar injections? What if foreign central banks refuse to cooperate? The assumptions that saved the system in 2008 might not hold in 2026. And the system has no backup plan. There's no alternative reserve currency ready to replace the dollar. The euro is fragmented. The yuan is controlled by China's government. Bitcoin is too volatile. Gold can't finance modern trade volumes. The dollar remains indispensable. But the Eurodollar system that makes the dollar work globally is dying. This is the ghost in the machine. A financial system everyone depends on, nobody controls, and no institution can replace. When it fails, and it will fail eventually, there's no plan B. Niall Ferguson's insight echoes through this entire history. Empires collapse when their financial systems become too complex to govern. The British Empire fell when sterling's role as reserve currency became unsustainable. The Roman Empire ended when currency debasement destroyed trust in money. The dollar empire is collapsing for the same reason. Not because America is printing too much money, because the shadow system that made dollars work globally has grown beyond anyone's ability to manage. The Eurodollar market was created by accident in 1957 when the Soviets wanted to hold dollars outside US jurisdiction. It grew because it was useful, providing cheap credit to fuel global expansion. It became essential because nothing else could finance trade on the scale civilization required. And now it's dying because the fragility built into its structure is finally overwhelming the trust that sustained it. The tragedy is that we understood this in 1980. Paul Volcker's study warned that the Eurodollar market would eventually destabilize the global economy. Milton Friedman predicted the crisis decades before it happened. The warnings were ignored because regulation would have required sacrificing growth. Politicians and bankers chose prosperity over stability. They accepted the fragility risk, believing they could manage the crisis when it came. They were wrong in 2008. They barely prevented total collapse. And they're wrong again in 2026. The system is collapsing on the same timeline, following the same pattern, with the same denials from authorities insisting everything is under control. It's not. The Eurodollar market is the final proof that the dollar's dominance was always an illusion. America doesn't control the world's reserve currency. $13 trillion, now $9 trillion, existed outside US jurisdiction, created by private banks making private decisions that could destroy civilization. The Federal Reserve could print dollars domestically, but couldn't control dollars created offshore. When those offshore dollars vanished in 2008, the Fed had to stretch its legal authority to breaking point to prevent apocalypse. The intervention worked, temporarily, but it established the precedent that the Fed would backstop a system it doesn't regulate and legally doesn't control. The precedent cannot hold forever. Eventually, a crisis will be too large, too fast, or too politically toxic to rescue. When that crisis comes, the Eurodollar market will collapse completely. The financial architecture supporting global trade will disintegrate. Countries will scramble to replace the dollar with alternatives that don't exist. The transition will be catastrophic, measured in millions of jobs lost and trillions in wealth destroyed. This is not speculation. It's the inevitable endpoint of a system designed without a lender of last resort, operating beyond regulatory control and building leverage on leverage for 70 years. The only question is timing. Will the collapse come in 2026, 2027, 2030? The date is unknowable. The collapse is certain. Return one final time to the Barclays ledger from September 14, 2008. Account 7739 USD. Deutsche Bank, $47 billion. That single page represents the ghost of empire, the shadow system that made modern prosperity possible and is now bringing it down. The paper survives in an archive. The system it documents is dying, and when it dies, the world will discover what happens when the invisible architecture of global power collapses and nothing exists to replace it. So here's the question that defines our economic future, and I want your honest answer in the comments. What should have been done in 1980 when Paul Volcker understood the Eurodollar market would eventually collapse? Should he have regulated it aggressively, accepting slower global growth but preventing the catastrophic fragility that nearly destroyed civilization in 2008? Or was he right to let it grow unchecked, betting that the prosperity created would be worth the eventual crisis? It's a choice between constrained stability and dangerous freedom. I'm reading your comments below to see which side you take. And if this deep dive into the $13 trillion shadow market changed the way you look at your mortgage, your pension, your dollar-denominated assets, hit that like button and subscribe. It tells the algorithm that this history actually matters today. Because whether it's 1957, 2008, or 2026, the tightrope remains the same. We are still caught in a system where prosperity depends on trust, where trust depends on ignorance, and where ignorance makes catastrophe inevitable. A system where the only real evidence left behind is the paper trail. A trail that leads us directly back to the single page that documented everything, back to the moment when the men in London knew the dollars were vanishing. Back to the ledger where the numbers told a story nobody wanted to believe. Back to the thin, translucent paper where the truth was typed in courier font and filed away in an archive. Back to September 14th, 2008. Back to the Barclays bank ledger. Back to account 7739 USD. Back to the invisible system that controls your life. Back to the shadow market that's dying right now. Back to the single page from a Barclays bank ledger dated September 14th, 2008, where the paper is thin and almost translucent under fluorescent light.